I don't think there's a bubble in everything. There's a bubble in some things, but I wouldn't call that in everything. Certainly not a bubble in oil prices with a barrel of oil at $56. I wouldn't call a bubble in small cap stocks. They've been left for dead. Bottom line is I think inflation volatility is here to stay. The bell's been ringing multiple times now on this AI tech trade, and I think that bell is going to continue to ring next year.
It's my pleasure to welcome back to the show Peter Boockvar. He is CIO at OnePoint BFG Wealth Partners and the author of the Boock Report, www.bookreport.com. So we'll talk about his views on the markets and the economy for 2026. Peter, it's been a while since you were on the show. Welcome back. Good to see you again.
Thanks for having me, Dave. It's actually on Substack.
Substack. Okay.
Yes.
Check out Substack, link down below. Well, Peter, it's been pretty much almost a year and a half since you were on the show. Time flies. Last time you were on in April 2024, you had said the 10-year Treasury yield was likely to retest, possibly break 5%. We've reached that point a couple times, not quite yet. Are you still bearish on bonds? Let's start there.
On long-term bonds. Short-term bonds are going to be influenced by the Fed rate cuts, but long-term interest rates around the world have continued to trend higher. On the day we're taping this, the Japanese 10-year JGB yield closed at the highest level since 2006. The German 10-year bond yield's at a 9-month high. The 30-year is just off a 14-year high. And I do think that while we've seen some pullback in the 10 and 30-year yield in the US, they still remain very elevated relative to Fed rate cuts. The Fed, if you look back over the last 2 years, so to capture the action leading into the September 2024 rate cut and then continue on through 175 basis points of cuts, the 10-year yield in the US is down all of 10 basis points, and the 30-year is actually a little bit higher. So it tells me that the Fed, ECB, Bank of England, which is about to cut rates, they are becoming less influential on long-term interest rates. And the bear market in duration, long duration, continues on.
Does that mean you're bullish on risk assets then, if you're bearish on long duration bonds?
I'm bullish on some risk assets and not others. If long-term interest rates continue to go higher, that's not going to be good for other risk assets, irrespective of what central bankers do on the short end. But positive again on some things and not on others.
Well, let's just start with your capital allocation thesis for 2026 then. So we started with bonds, risk assets, some good, some not. And like you said correctly, long-term yields going up can't be great for all risk assets. What do you like then?
Similar to what I liked in 2025. The interesting thing about 2025 is that investors sort of widened the aperture of their investment horizon. Coming into the year, the markets were dominated by the top 7-8 names that we all know, and that trade, that Mag 7+1, I had Broadcom, really splintered this year. And while the group still performed pretty well, it underperformed a lot of other parts of the market, and particularly international stocks and precious metals and other commodities, energy, and some small mid-cap parts of the market too. I do think that I think the AI tech trade is exhausting itself. I think the bell is ringing here, and Oracle is the one that rang the bell, not with their last quarter when the stock fell sharply, but after the spike in the previous quarter in the stock and that come down. That was the bell ringing when it gave back all of those gains. And we've seen a subsequent number of events like CoreWeave's earnings, the Gemini 3 news out of Google that made people question the OpenAI ecosystem, and more questions about all this spend and whether it's going to be worthwhile, because the spend is quite extraordinary.
And just today, we're seeing news out of Oracle that their deal with $10 billion deal with Owl Capital has fallen off. Blue Owl had been in talks with Oracle about funding a 1 gigawatt facility for OpenAI in Michigan, according to the FT, but plans fell through due to concerns about Oracle's rising debt levels. Now, a lot of companies are using debt to finance AI expansion. Oracle is just one of them. Do you see this problem persisting throughout the entire AI sector?
Well, it was Blue Owl that decided not to do the deal, and it looks like Oracle is going to replace that financing from somebody else. So it's not like the project is not getting done, but it does highlight that, at least from the private credit standpoint of Blue Owl, that maybe they're putting some of these deals on sort of a tighter standard. And we'll have to see what repercussions that has in terms of the cost of capital and ability for these data center financings to take place going forward.
Just on a micro level, whenever a company takes on more debt, it's more risky, but potentially the ROI on this debt, if they're using it to finance expansion in AI and other things, is so high that it almost doesn't matter. Is that the case for tech?
That remains to be seen. And it's not just the debt, it's the lease obligations that is being created here. It is the higher depreciation expense that's going to be embedded in the earnings. So we basically, with this AI data center build out, altered the business models of a lot of these companies, the big hyperscalers, from asset light, highly cash generative businesses with high returns on equity to highly capital intensive businesses that are going to generate less cash flow, at least for now. And that obviously negatively impacts their growth rates, earnings growth rates going forward. So I don't think you can analyze these companies and their stocks with the same lens as you did prior to all this spend beginning in the latter part of 2022 and into 2023.
You mentioned quite a few assets in the beginning of the interview when I asked you about asset allocation, but the truth is, Peter, it's not just tech stocks that have gone up, it's precious metals. Well, Bitcoin's down in the year, but relative to a year and a half ago, it's still up tremendously. And so people are talking about not just a tech bubble, but an everything bubble, Jim, and Peter. So in that particular scenario, what do we rotate capital to? Is there a safer place valuations wise?
Well, the bubble is not is in the capex spend part of AI. You take precious metals, are they a bubble? Well, not really when you look at over the last the rise in central bank balance sheets, the global rise in money supply, its percentage of total financial assets. It's far from a bubble. I mean, you look at silver at $65. While it's gone vertical here, and it might be prudent to take a tiny bit off the table. It was $50 45 years ago, so it's barely above where it was. So that's not the hallmark of a bubble. So I don't think there's a bubble in everything. There's a bubble in some things, but I wouldn't call that in everything. Certainly not a bubble in oil prices with a barrel of oil at $56. I wouldn't call a bubble in small cap stocks. They've been left for dead. And international markets, which have done tremendously this year, and I remain bullish on, 1 year of outperformance doesn't qualify as a bubble.
You already know why people hold gold. It's because it's real money. But what if your gold could do more than just sit in a vault? Well, that's where our sponsor today, Monetary Metals, comes in. They offer a way for you to earn a yield on your gold paid in physical gold. Through their leasing marketplace, you can earn up to 4% yield per year in gold. Instead of paying storage fees, your gold actually works for you. And because that yield is paid in gold, not cash, your stack grows no matter what the dollar is doing. Thousands of clients already earn monthly interest in gold and silver through Monetary Metals, and the numbers just keep climbing. So don't just hold gold. Start earning real gold on your gold today. Go to monetary-metals.com/Lynn, link down below, or scan the QR code here. Put your gold to work soon. If tariffs and Fed pivots were major themes for 2025, what would be the major themes for the next year?
Well, it's what happens of this Gen AI tech trade, and
Okay.
not just from the stock market perspective, because they dominate the indexes, as we know. But if there's any issues with the stock market, that's going to spill over into upper income spending, which is a key support for the U.S. economy. And if the data center facility build out slows down for whatever reason, now of course the projects that are in process they'll continue on. But if there are any delays because of power access or whatever, if there are any cancellations, if there's any slowdown, that could have economic repercussions as well, since the U.S. economy has been highly reliant on the data center building and generating GDP growth.
Since we were on last year, inflation has slowly trickled up far beyond the Fed's 2% target. Let's talk about your outlook on inflation. Any updates to inflation? You've argued it wouldn't just go down to 2% and magically just stay there. And given all the developments since 2024, what's your outlook now?
Well, I still believe that we may go to 2% from a rate of change standpoint for a period of time, but I don't think we sustainably stay there. One of the main factors that could do that is the slowdown in rents, since that dominates the CPI. But we're already sowing the seeds for further acceleration in rents, probably sometime in the back half of next year into 2027, because currently we're absorbing a lot of supply in 23 and 24 that is tempering rental growth. But because there's been a notable decline in new construction of multifamily, will eventually see a reacceleration, because there's been very healthy absorption when it comes to all this supply, because it's been very expensive, particularly for first-time buyers, to purchase a home. So I expect inflation volatility. And to my point, as you mentioned, that I made last year, I don't expect us to go to 2% and magically stay there. We may go to 2% temporarily, but I expect a reacceleration thereafter. Bottom line is, I think inflation volatility is here to stay. I think the tariffs, while technically is a tax and therefore a one-time impact on inflation, I think because it is sort of distorting and mixing around global supply chains to higher cost places, its impact is going to be multiple years. And I do think we're embedding a higher cost structure for a lot of companies because of these tariffs.
How does that impact the Fed's decision then, especially since we're still undecided as to whether or not it's going to be Warsh or somebody else, or Hassett taking over Jerome Powell next year? But the fact of the matter is, whoever takes Powell's place is probably going to be more dovish than Powell himself. But on the other hand, like you said, inflation continues to stay sticky and elevated and be a problem. So where does that leave the Fed's decision?
Well, whoever the next Fed chair is, yes, they're going to be cutting rates, but Powell's been cutting rates too. It's just a question of how far they take rates, and I think a lot will depend on not just inflation, but the flow through of the rate cuts into the dollar. Because if the dollar takes another leg down, that's going to be inflationary. And if long rates go up, because that part of the curve is not happy with the Fed rate cuts, then that's just going to offset and dilute the Fed rate cuts. So I do think that there's a marketplace that is going to speak up if they think the Fed has taken the Fed funds rate too far relative to the economic factors that are out there. I understand the concerns about a slowing labor market. I see it. There's no question there's been a slowdown in hiring, but with inflation still remaining well above 2%, both on an absolute basis and on a sustainable basis, the Fed still has to be very careful with what they do.
And going back to tech stocks, which is more important for the margins, the long end of the curve or the short end?
Well, if you're looking to buy a house, the long end, of course, is more important. If you're looking to finance long-term projects, the long end is certainly more important. If you're a SOFR plus borrower, well, then you're more focused on where the Fed funds rate is. So it really depends on where along the curve do you borrow. But the point is that for now, central banks have sort of lost the ability to influence the whole yield curve. The ECB has cut their deposit rate by 200 basis points, and that hasn't stopped the German 30-year bund yield to go to 14-year highs. The BOJ is about to raise interest rates, which I think is very noteworthy, and also will be a major bond factor in 2026, because it may not just be one more hike, it could be a few more next year. And we've seen that, as I mentioned earlier, seen in the long end of the JGB yield curve.
So what is the trigger for the AI sell-off? At what point in the steepening of the yield curve do we see margins really start to compress? And maybe it's not a factor of yields impacting their margins. Maybe it's something else, Peter.
Well, the trigger's already happened. I mean, look at the stock price of Oracle. And again, not just before this sell-off on earnings, it started to sell off well before that, as people looked at and analyzed the extent of which they are creating their obligations, debt obligations, lease obligations, and heavily reliant on OpenAI. Then you had CoreWeave. People are questioning now their business model. You had, I mentioned the Gemini 3, and people questioning the OpenAI model relative to the competition. With China, with their open source models, creating a huge competitor with US technology. So the bell's been ringing multiple times now on this AI tech trade. And I think that bell is going to continue to ring next year.
You mentioned Japan earlier in the interview. What do you make of the fact that the Japan JGB 10-year is now at the highest level since basically the mid 2000s? Is this going to cause a ripple effect on markets? Is the unwind of the Japanese carry trade going to happen?
Well, I do think it's a really big deal. The long end of the yield curve is essentially tightened for the BOJ. I mean, even with a BOJ rate hike to 75 basis points, they continue to drag their feet relative to inflation, which is running 2.5 to 3.5%. So the bond market said, "Hey, BOJ, we're not going to wait around for you. We're just going to tighten for you." And with respect to the carry trade, I don't know what's left of the carry trade. I don't know how it is in terms of size. But I do know that JGB yields are becoming much more attractive for global investors, particularly Japanese investors that are still very heavily invested outside the Japan, particularly in the U.S. Treasury market. So if that yield rise does continue, there's no question it can have ripple effects globally in terms of fund flows.
As an investor, are you more enticed to invest internationally away from U.S. domestic companies because of interest rate differentials happening worldwide?
Not necessarily interest rate differentials, somewhat that, but I just find that in terms of a value-seeking investor that I am, I'm finding just more opportunities out there. I also do think that the US dollar, which has had a tough year this year, will continue to weaken. I will get help investing internationally because of that. And on the emerging market bond side, to your interest rate differential point, I do think local currency emerging market bonds are really attractive, both because of the interest rate differential and also the very high real rates that they provide, but also play on a weaker dollar.
What do you make of the national deficit, $1 to $2 trillion a year? I believe is depending on which source you're looking at, is the number we're running on right now. At what point does the market realize this is a problem, or maybe it's not a problem?
Well, the market, I believe, already realizes it's a problem, and that's why one of the factors in why long-term interest rates around the world are going up. They're going up in Japan, heavily indebted, going up in the UK, heavily indebted, in the UK, in Germany, which is now ramping up fiscal spending, in France, in the US. I think debts and deficits now do matter, and it's being reflected in elevated long-term interest rates.
Since Trump was in office, which is after our last discussion, any particular trends in demographics or changes in demographic trends that you think are important for monitoring?
Well, that's more of a longer term play in terms of I should say a longer term thing on how it plays out. Birth rates in the developed world is slowing dramatically. It's the worst in South Korea, where I think it's under one. And yeah, over time, that is a major thing that we need to pay attention to. How to react to it now, it's you really can't, but over the next 10, 20 years, it's definitely important to gauge in terms of how it's going to impact global growth rates.
Yeah, fertility rate is below 2 in many developed countries. But what about the immigration rates coming down for, let's just focus on the U.S. How's that going to impact the labor market going forward? We're speaking today on mid-December, and the unemployment rate that just came in, which is a few months old, 4.4%, the highest it's been since 2021, I believe.
Yeah, it's going to affect the supply side of labor, no doubt. But at least for a portion of these immigrants, it's illegal because legal, it's perfectly fine to still come here. But illegal, it's, they were mostly working in leisure and hospitality, construction, key areas that we need people in. But it's hard to draw a broad brush. I think overall, labor force increase is probably a quarter to a third of a percent, which is pretty lackluster. So you're going to really need strong productivity growth to generate anything close to 2% GDP growth, which we may see. AI may help that, but we'll have to see how that plays out because without that labor force growth, you need that productivity increase to really drive overall growth.
Okay, let's move on to commodities and hard assets. Now, since you're on the show in mid 2024, the silver price is up 160%, give or take. Gold's up 90%, almost 100%. Are we still in the middle of a commodity super cycle, if that's what's happening right now, Peter?
I don't like to use the words super cycle. I just think it's a bull market that will continue. I do think from a portfolio management standpoint, when something goes vertical, it's important to just respect that it's maybe time to take some chips off the table, which we've done over the last call it month in gold and silver. But still remain very long and very positive, but acknowledge that when something gets extended, it may be time for a break, just as any sprinter needs to take a deep breath. But generally speaking, we still think that there's more upside, and we're still long these commodities. My favorite commodity for 2026, though, is oil. I think at $56 a barrel for WTI, it's probably one of the cheapest assets in the world, and finding it a very attractive place to invest right now as a contrarian.
Is that simply based on current price levels compared to historical price levels, or are you bullish on demand and bearish on supply?
It's both. Right now, the consensus is that we're swimming in too much oil.
Yeah.
I think that is exaggerated. I think that there's down here in the mid 50s, there's going to be a big supply response. I mean, U.S. shale, half of U.S. shale doesn't make money in the low 50s or high 40s. So you will shut down half of that industry if oil prices fall much further. And the Saudis aren't happy with mid 50s oil either, and nor is the rest of OPEC. So I wouldn't be surprised if there's a supply response there as well.
Okay, so we talked about the AI trade, but the stock market, the big indices, S&P and Nasdaq, well, Nasdaq in particular, but just even the S&P, there's a huge concentration risk out there. And if you're somebody who is maybe not actively investing or trading, it's difficult to avoid this concentration risk. Is this basically 2026 a year of stock picking? Is that what we're suggesting here?
Well, I think 2025 was as well.
Okay.
And I do think that that continues into 2026 is yes, concentration risk. We know that the top 10 stocks in the S&P are 40% of the index, and technology, generally speaking, is about that ratio. So yes, I do think that there's an opportunity to do well relative to the S&P by picking stocks that are not included in that group, because that group, I think that trade is sort of exhausting itself here.
So, given that you think inflation will stay sticky, the long end of the curve is going to probably continue to go up, if not stay sticky around current levels. How do you compare cash versus real assets versus yields?
Well, the bond market is not very attractive, as we talked about. If you want to have some cash, cash is always nice because it's dry powder and optionality. And while central banks have been cutting interest rates, you still get a yield of some sort. It's not like you get paid nothing like we did when we had 15 years of zero rates here and we had negative rates overseas. So cash is always important to have, particularly if the market's going to have any difficulties next year, if the AI trade continues to sort of lose its dominance. Commodities, I do think, as we talked about, I think is an attractive place. I would add ag to that too. We own some of the fertilizer stocks as a beaten up group. So I do think that similar trends of 2025 with a bunch of things working around the world, I'm hopeful that that can continue next year.
And if, let's say, we were to fast forward a year or two from now, what do you think are the biggest market risks that investors are discounting right now? Is it just AI or is it something else?
No, AI, yeah, it's definitely AI, as we said. I think if long rates continue to hire, that'll be an issue. And we're watching if this hiring rate slows down in the US and that starts to negatively impact the economy. The data center build out slows. We've seen a huge amount of money pile into private credit. And usually when too much money chases something, that there's not enough good loans out there for all that cash. That's something that I'm watching as well. So a combination of those factors, I think, should be on sort of the investing dashboard of people as we look to next year.
Well, if you just take a look at my screen right now, the advanced retail sales as published by the St. Louis Fed is still near all-time highs. In fact, actually, it is at all-time highs. So people are still spending money. The year-on-year change is not slowing down. If you just take a look here.
That's a nominal term. So as inflation helps that number.
I see. So it's not just so what you're saying is not more volume of spending. It's really just prices going up.
Well, the last couple of years, it's been a lot of that's price.
Okay, but do you think that the K-shaped recovery, the economy that people are talking about, that the wealthy are going to continue driving spending, and so even if the labor market deteriorates for the middle class, it doesn't really matter? Do you buy that narrative?
Well, yes, there's a wealth effect for sure with the stock market, but that means that the stock market needs to hold up. If the AI trade drags it down, then that upper income spend is going to be put into question.
What needs to happen for, I guess, the affordability crisis that the Trump administration keeps talking about to be solved? Is it something to do with fiscal policy? Do we just need to see a natural equilibrium of stock prices go down and housing prices correct with it? Is there something the government can do to intervene?
Well, I think if the Supreme Court upholds the lower court's ruling that the president's use of emergency powers to implement tariffs, if that is proved to be unconstitutional, then we'll see a major tax cut in a variety of different things. That would certainly help the affordability issue. I think most of the pain with higher prices is in the shelter side, and I think lower home prices, while it would, negatively impact the equity of existing home buyers or home owners, I should say, would certainly help new home buyers because they're the ones that are feeling the affordability squeeze the most.
Well, now that we've basically had almost a year of data on what happened or has happened since tariffs were implemented post-Trump, who can you assess to be the real winners or losers coming out of the trade war this year?
I can't find too many winners. I don't think that trade wars create winners. And there are plenty of losers, I believe.
Well, from an investment standpoint, how does this impact trade, where your trade's going forward? If you let's assume that this continues.
Well, if it continues, I mean, I think investors need to, pay attention a lot. I mean, to how companies have mitigated it. Larger companies are much more flexible and able to absorb the tariffs, either through their vendor negotiations or their ability to pass through price. Or yes, a lot of times they have to absorb it too, but because they're big and they have juicier profit margins, they can. It's really been small, medium-sized companies that have been most damaged by the tariffs, and that's why I'm hoping they get some relief. And if they don't, then that will negatively impact them. I mean, if you look at hiring, small business hiring really took a leg down beginning in April, just when the tariffs really hit us. So I think that is noteworthy.
Okay, finally, anything that surprised you for 2025 that you weren't expecting investment-wise, and what can we learn from that?
I'm surprised that oil prices have fallen as much as they have. Not much else really has. Not much. I mean, there's always something that surprises, and no one has the ultimate
Sure.
crystal ball, and for sure. But it's a good question.
Well, one thing that surprised me initially, and maybe some other people, maybe not, but the DXY fell on Liberation Day on April 1st and 2nd, and it's pretty much stayed range bound ever since. You would expect, just looking at Trump's first term, that the dollar would appreciate versus other currencies when tariffs are implemented. Why didn't it happen this time around?
Well, yeah, on paper that was supposed to be the outcome, but I think you pissed off the whole world. And everyone said, well, do I want to own as many US assets? And if I do want to own the same amount of US assets, I'm going to hedge my exposure. And we've seen a lot of foreign hedging of dollar exposure on their US dollar assets. So while they maintained and maybe even increased in certain areas US asset holdings, they've dramatically increased the level of hedging. So you can actually see coming into April, the year prior, there was a pretty good relationship between the dollar index and the Mag 7 trade. The Mag 7 trade essentially became a reserve asset for foreigners. They piled onto the same trade as U.S. domestic investors did. But after April, the U.S. stock market had a nice rebound off those lows, but the dollar still was stuck in the mud. And I think that is because a lot of the hedging that has taken place against owning U.S. assets from a foreign perspective.
Okay, well, let's just take a look at that. So we have here the DXY overlay with the NASDAQ, and I just want to get your perspective here. In the past, not a huge direct correlation, but you can just see the NASDAQ take off in the blue line, irrespective of the dollar just flatlining around here ever since April. And so this divergence between the dollar and the NASDAQ, how can we explain that given what you've just said?
Well, no, I just explained it. It was buying U.S. tech stocks, but hedging that exposure rather than buying it on an unhedged basis. And there's no doubt with the the blue line is that the AI tech trade got a second wind after both the DeepSeek news in late January and the tariff news in early April. But again, heavy hedging that I think helps to explain that divergence post April.
So what's your outlook for the DXY in 2026, especially given that the long end of the yield curve is expected to stay high?
I think if the Fed keeps on cutting interest rates, and I think if this trade war continues on, the dollar, and if the AI tech trade softens and global investors start to sell, I think that's going to be negative for the U.S. dollar.
Excellent. All right. Thank you very much, Peter. Appreciate your thoughts. Where can we follow you? I mentioned you have a Substack, the Boock Report. Where else?
So yeah, type in my name in Substack, and you can check that out. I write daily on the macro and markets, and then on the wealth management side, they can check out our website, OnePointBFG.com, to learn more about what we do.
Okay. Thank you very much, Peter. Appreciate your thoughts. Happy New Year. Happy holidays, and we'll see you again in 2026.
Thanks so much.
And thank you for watching. Don't forget to like, subscribe, follow Peter in the links down below.